The air feels different, doesn't it? There's a subtle, yet persistent, pressure that's become harder to ignore. It's the whisper of inflation, not just as an economic statistic on the evening news, but as a tangible force eroding the value of hard-earned money, the fruits of your labor, and the promise of your investments. For ambitious professionals, for the active and aspiring investor, for the entrepreneur building a future, this isn't just an abstract concern. It's a direct assault on your ability to accumulate and preserve wealth, a challenge that demands more than just a passing glance. You feel the urgency, the gnawing awareness that the ground beneath your financial feet is shifting. We're here today not to offer platitudes or quick fixes, but to unpack something far more substantial. 6 foundational principles, 6 deeply ingrained understandings that can transform the way you navigate these inflationary currents. These aren't hidden spells or arcane rituals, but rather a framework, a way of seeing and acting that cuts through the prevailing noise. Think of Benjamin Graham, the father of value investing, who reminded us that the investor's chief problem is never the market or the economy, but himself. This journey into maximizing returns in high inflation is, at its core, a journey of mastering that internal landscape, of understanding your own biases, and of applying rigorous, data-driven strategies that the mainstream often overlooks. We aim to move you beyond the reactive fear that inflation often breeds, transforming this perceived crisis into a fertile ground for informed, strategic wealth preservation and growth. This is about equipping you with the clarity and the confidence to not just survive, but to thrive, by dissecting the very mechanics of inflation and revealing specific, actionable tactics rooted in the timeless wisdom of fundamental analysis and the profound insights of behavioral economics. What's really driving the market in times like these? And more importantly, how can you position yourself to not only protect your capital, but to see it grow meaningfully? Let's begin to uncover these truths. The first secret to maximizing your returns in a high inflation environment lies in understanding what truly acts as a shield, a bulwark against the erosion of purchasing power. We often hear simplistic pronouncements: gold is the answer, real estate is the unassailable hedge. While these can offer a degree of protection, the reality is far more nuanced. Data from various inflationary periods shows that their correlation is not always as straightforward as commonly believed, and their effectiveness can be significantly hampered by leverage and market sentiment shifts. Instead, we must look for real assets in a more sophisticated sense. This means focusing on companies that possess intrinsic value and, crucially, pricing power. Think of businesses with tangible assets that are essential, or those that provide services so fundamental that they can confidently pass on rising input costs to their customers without losing significant demand. Consider commodity producers operating with long-term, sticky contracts, or providers of essential utilities. These are the entities that can not only withstand the storm of rising prices, but can actually benefit from it. The allure of traditional real assets like property can be deceptive in rapid inflation. The hidden costs of illiquidity become starkly apparent when borrowing costs surge, and the very market sentiment that drove prices up can reverse with alarming speed. This is where a discerning eye for corporate strength becomes paramount. So, how do we identify these resilient companies? Develop a framework for spotting pricing power modes. Look for businesses with consistently high gross margins, indicating they can maintain profitability even as their costs increase. Examine their debt levels. Lower leverage means less vulnerability to rising interest rates. Crucially, consider the essential nature of their services or products. These companies are like a well-built ship with a strong hull and a captain who can expertly adjust the sails. They navigate the inflationary storm rather than being overwhelmed by its waves. This is the first vital secret to building sustainable returns. The second secret to navigating a high inflation environment involves a delicate dance, a sophisticated understanding of interest rates and bond valuations. It's crucial to grasp the fundamental inverse relationship. As interest rates rise, bond prices fall. This isn't a mere academic concept. It's a direct consequence of central banks acting to curb inflation by increasing borrowing costs. A key factor in how much a bond's price will fall is its duration. Duration essentially measures a bond's sensitivity to interest rate changes. Consider recent history. Bonds with longer durations, like 10-year treasuries, have seen substantial price declines as rates climbed. This starkly contrasts with shorter duration instruments or floating rate debt, which are less susceptible to these sharp drops. This is why the age-old adage that bonds are safe can be a dangerous oversimplification in inflationary times. While they may offer stability in low-rate environments, capital loss on long-duration bonds can significantly drag down your overall portfolio returns when rates are on the ascent. So, what's the actionable insight here? It's about analyzing bond duration with a discerning eye. When inflation is high and interest rate hikes are on the horizon, consider strategies like laddering your bond maturities. This involves staggering your bond investments investments across different maturity dates, reducing the impact of any single rate hike. Alternatively, focusing on short-term instruments or favoring floating rate debt whose interest payments adjust with market rates can offer greater resilience. Think of it like a seesaw. Interest rates go up and bond prices go down. Understanding duration is like knowing just how far that seesaw will tip. It's about anticipating the movement, not being caught off guard by it, and making informed choices to protect and grow your capital even as the economic ground shifts. This nuanced approach to fixed income is a vital secret for success. The third secret to navigating high inflation lies in understanding a less discussed, yet profoundly influential, economic concept: the velocity of money. This refers to how quickly money circulates throughout the economy. Think of it as the speed at which your dollar changes hands. When this velocity picks up, especially in an environment already constrained by limited supply, it can act as a powerful accelerant for inflation, igniting price spirals that feel relentless. History offers compelling evidence. Periods marked by a surge in money velocity have often coincided with rapid price increases. These surges are frequently fueled by a confluence of factors: heightened consumer confidence, significant government stimulus packages, or critical supply chain disruptions that limit the availability of goods and services. When people feel confident or compelled to spend, and there simply aren't enough goods to meet that demand, prices are pushed upward. There's a subtle, perhaps even unintentional, hidden incentive at play here. Governments and central banks, in their efforts to stimulate economies, might inadvertently foster this high velocity. Stimulus checks, for instance, can encourage immediate spending. This creates a psychological trap. Consumers spend quickly, fearing that prices will only climb higher if they wait, further exacerbating the inflationary pressure. To harness this understanding, it's crucial to monitor key economic indicators. Pay attention to measures of money velocity, such as changes in the M-to-money supply relative to GDP, and keep a pulse on consumer sentiment surveys. These can offer early warnings of potential inflationary pressures building beneath the surface. Consider this analogy. Imagine money as water in a complex plumbing system. If there's an abundance of water, a large money supply, and it's flowing with great speed through narrow pipes representing limited goods and services, the pressure within that system inevitably builds up, leading to inflation. Understanding this velocity dance is a critical secret to anticipating and managing inflationary forces. As inflation continues to exert its pressure, the fourth secret shifts our focus from the often volatile pursuit of pure capital appreciation to the steadfast power of income generation. In an inflationary landscape, consistent cash flow, particularly from dividends, can prove to be a far more resilient force than fluctuating stock prices alone. This is about building a financial foundation that provides a steady stream of support even when the economic winds are strong. We must highlight companies that don't just pay dividends but have a strong history of growing those payouts. These are the businesses with durable business models, consistent earnings growth, and the inherent ability to increase their payouts year after year. Think of companies with essential products or services, those whose earnings are not easily disrupted by rising costs. These dividend increases act as a direct hedge against inflation, ensuring your income stream keeps pace with the rising cost of living. The perceived dichotomy between growth stocks and income stocks often dissolves in these environments. High-quality dividend-paying companies, those with robust underlying businesses, can offer the best of both worlds: potential for capital appreciation alongside an inflation-adjusted income stream. This powerful combination is a cornerstone of sustainable wealth accumulation. To implement this, a clear, actionable insight is to identify what are known as dividend aristocrats and dividend kings. These are companies with exceptionally long track records of increasing their dividend payouts. But don't stop there. Analyze their payout ratios to ensure they aren't distributing an unsustainable portion of their earnings, and scrutinize their dividend growth rates and the fundamental strength of their businesses. This diligence ensures the reliability of your income buffer. Consider a strong dividend-paying company as a well-maintained tree. It stands firm through challenging weather, consistently bearing fruit that nourishes and sustains. In the inflationary climate, this reliable, growing income is essential. This is the dividend dynamo, the fourth secret to maximizing your returns. The fifth, and perhaps most crucial, secret to thriving in a high-inflation environment is the construction of a robust behavioral fortress. Inflation doesn't just impact our portfolios, it preys on our psychology. The fear of missing out, or FOMO, on assets that seem to be soaring, the primal urge to hoard tangible goods, and the siren call of impulsive decisions fueled by alarming headlines. These are the emotional currents that can derail even the most well-intentioned investor. We are all susceptible to cognitive biases. Anchoring bias can cause us to fixate on past prices, preventing us from seeing current value. Loss aversion makes us cling to losing assets, hoping for a recovery that may never come. And the powerful pull of herd mentality can draw us into speculative bubbles, following the crowd into assets that are detached from their intrinsic worth. The systemic risk is amplified by mainstream financial media, which often, perhaps unintentionally, exacerbates these biases. Narratives can emerge that encourage speculative fervor or sow panic, leading to suboptimal investment decisions and ultimately disappointing outcomes. It's a cycle that feeds on emotion rather than reason. The actionable insight here is to actively build your behavioral fortress. This means committing to a predefined investment plan and adhering to it with unwavering discipline. Regular rebalancing of your portfolio, selling what has become overvalued and buying what has become undervalued, is a critical practice. Cultivating mindfulness, a conscious awareness of your emotional state, can help you pause before making rash decisions. And critically evaluating your financial news sources, seeking out data-driven analysis rather than sensationalism, is paramount. As Warren Buffett wisely stated, we don't have to be smarter than other people. We just have to be more disciplined. This discipline, this ability to guard against the psychological traps of inflation, is the ultimate tool. It is the bedrock upon which sustainable returns are built, the fifth secret to navigating these challenging economic times. We've journeyed through the 6 essential secrets for not just enduring, but truly maximizing your returns in a high inflation environment. We began by looking beyond simplistic hedges to uncover companies with genuine pricing power, those resilient real assets that can weather the storm. We then navigated the delicate duration dance, understanding how to protect your fixed income investments amidst rising interest rates. We unmasked the velocity of money as a critical inflationary trigger, highlighting the importance of monitoring economic flow. The dividend dynamo revealed the power of consistent, growing cash flow as an inflation buffer, and we fortified our minds by building a behavioral fortress against the psychological pitfalls of inflationary fear. These secrets are not isolated tactics. They are interconnected pillars of a holistic strategy. They underscore that true wealth building, especially in challenging economic times, is not about chasing speculative trends or relying on luck. It is about informed decision-making, astute risk management, and unwavering behavioral discipline. It is about creating a margin of safety, as Benjamin Graham so wisely advised, by purchasing securities at a figure below their intrinsic value, a principle we've applied by focusing on fundamentally sound assets, resilient income streams, and psychological fortitude. Now, the power rests with you. Take these insights, conduct your own diligent research, and begin to weave them into a personalized strategy that aligns with your unique financial goals and risk tolerance. The journey of financial mastery is continuous, and in environments like these, proactive understanding is your greatest asset. If you found value in this deeper dive into navigating inflation, we invite you to subscribe for more in-depth, data-driven financial analysis. Your engagement fuels this exploration, and in the spirit of shared wisdom, please share your own strategies or any questions you may have in the comments below. Let us build a community of informed, disciplined investors who are not just prepared for the future, but are actively shaping it. What is the first concrete step you will take today to strengthen your individual inflationary blueprint?